And there's again, we keep hearing that there aren't that many advantages.
You got it up on the screen.
Yes, here it is. So the wash sale rule is an Internal Revenue Service regulation that prevents a taxpayer from taking a tax deduction for a security sold in a wash sale. The rule defines a wash sale as one that occurs when an individual sells or trades a security at a loss and within 30 days before or after the sale buys a substantially identical stock or security or acquires a contract or option to do so. A wash sale also results if an individual sells a security and the individual's spouse or a company controlled by the individual buys a substantially equivalent security. Okay.
I think 30 days is a little aggressive.
Well, they say before or after, right? So that's where it does get complicated about why that is, right? So why is that? And the wash sale rule is designed to prevent people from selling securities and taking a loss strictly for tax purposes and then buying the security back. So now I get the loss on my tax return, plus I still own the stock, right? So here's the difference, right? And we've talked about this, about what's the difference between crypto and stocks. Right, because now we know, because we've been talking about it here for the last couple of weeks. Crypto isn't stock. Crypto is property. So property is different than stock. It's treated differently. There's a loophole here that you can drive a truck through, maybe, about crypto, and especially
I like how you say maybe, because like anything in tax law,
it depends.
It depends.
And again, remember, this isn't tax advice, and it's not financial advice. We're just talking about information. I'm just telling you what's out there, right? So there's a story.
You're just pretty much talking about the statute, the way everything is explained, right? Because that's what your job is to help inform. So
again, this isn't about tax advice or financial advice. It's about giving you information. Okay, and so now let's talk about the tax loophole. Okay, and we've talked about crypto. We know that crypto is property. Crypto is not a stock. Okay, so when you buy and sell it, every time you buy and sell it, it's a tax consequence, right? Even if you buy something with it or someone gives it to you for income, then it's income tax. If you sell it, then it might be a capital gain or a capital loss. So I found a story from Forbes from last year. And so let's talk about this story.
Is this a story? So this was from last year. This was 1 year ago?
This is February 2020 when things were going up.
Good.
Okay,
so things were good.
Yes, and it's been a year now.
It's actually not too bad.
So let's talk about this story. Okay, so now,
remember, everybody, Open Tax Advocates is there for you at 312-664-6649. If you were looking for any tips on how to solve your IRS problems,
that's right.
I don't know if you know this, but Attorney Steven A Leahy wrote a book called
Deal with your IRS problem today.
Well, eventually you'll solve it.
That's right.
If you deal with your IRS problem today.
So let me talk about this.
FreeIRSbook.com.
Tax loopholes are interesting gaps in the IRS code, which you can use to reduce your taxes legally. This post discusses an important crypto tax loophole, which could significantly reduce your crypto tax bill. Cryptocurrency trading has one major tax benefit that traditional stock trading does not offer unless you are a full-time trader. Since cryptocurrencies are treated as property, wash sales rules, which is applicable to stocks, are not applicable to crypto. Not having to follow wash sales rule is extremely beneficial for tax purposes, especially during times where your position has gone down in value. Okay, so I can give you an example, but I think there's an example in this article. So a wash sale occurs when you sell a property, sell a security and at a loss, and then purchase that same security or substantially identical. Now we just went through the
that's cocktail.
So I'm going to skip that. Okay, assume Sarah buys $10,000 worth of company A stocks, 1,000 shares at $10 each, on January 10th. And on January 15th, Company A stock is trading at a much lower price at $6. If Sarah were to sell her position and buy another 1,000 shares at $6 per share, she would not be able to claim the capital loss of $4,000 due to the wash sale rule.
I like how they do the equation right there where they could have easily just calculated that. It's like,
Therefore,
you lost $4,000. You had to overcomplicate everything.
Therefore, $4,000 loss is disallowed under the wash sale rule. And this is what happened to my client, right? He thought he had some losses. And so at the end of the year, he's adding his gains and subtracting his losses. And he came up with a different number than his brokerage did, right? When they sent him that, he's like, this isn't right. And the answer was, it was right. Yes, Jim.
So there needs to be some more digging because, yes, this is a year ago and we're all learning about this. Now, we're all talking about this now on today's Tax Talk Tay Tray. Mm-hmm. But we need to kind of understand, if you are a Robinhood investor, do you own this property or is it treated as a stock because there's a holding company that's holding onto this asset in your name?
I believe it's still property. It's not, it doesn't change the character of the I don't know we've talked about Robinhood before and whether you actually own the equity or the property behind what you're buying and selling, or whether you just it's fictitious. But I don't think it changes the nature of that property. That's something we can look for. Take a note on that, Jim.
I will take a note. And remember, ladies and gentlemen, if you have any questions for Attorney Steven Leahy, you can ask away.
In contrast, now here's the cryptocurrency. In contrast, trading cryptocurrencies, which act like stocks, but under the tax treatment of property, generate a much better tax benefit. Let's say instead of buying company A stocks on January 10th, Sarah buys one Bitcoin at $10,000. Like you could buy Bitcoin you could have last year. On January 15th.
Who said that? What is this?
I'm just laughing because he says that buy one Bitcoin for $10,000.
Somebody call Forbes. Yeah, I think even then it wasn't.
This was last year, though. This was 2020.
I'm pretty sure 2020 this time it wasn't $10,000.
It was the
sure it was
whatever. He's giving an example. Okay. On January 15th, this person goes down. The price of Bitcoin goes down to $7,000. At this point, what she could do is sell the Bitcoin for $7,000, harness the $3,000 worth of tax losses, and buy back another Bitcoin to maintain her position. $3,000 loss would be allowed on your tax return as a capital loss because the Bitcoin is not subject to the wash sale rules like stocks. So right there, that is such a benefit right there. So now there's $3,000 loss that you wouldn't otherwise be able to take. It's huge.
That's absolutely huge. I would have sold a long time ago.
So maybe we could, if you have a mixed portfolio or a diversified portfolio,
write this down,
which most people should have. And again, I'm going to say we're not giving tax advice or investment advice, just information. But let's say that
that's an opinion, sir.
But maybe if you have a diversified portfolio and you have stocks that are up and you want to sell them, maybe now's the time to sell them, and then then you could sell your Bitcoin and then buy them right back. Now you get the loss to wash off the profit.
We'll
That's how that would work.
That's maybe.